Welcome to the Opening Bell Report.
Usually when we sit down to unpack a market mover, we are looking at something a bit more predictable.
A steady trend.
Yeah, a slow burn breakout, maybe a geopolitical shift, nudging oil prices. But today we're looking at something that honestly feels like a glitch in the matrix.
It definitely gets your attention.
I actually refreshed my screen 3 times. I just didn't believe the percentage.
Plus 232% in a single trading session.
And that's just the day session. The after hours tacked on another full dollar. It's vertical.
It is.
We're talking about ticker symbol RIE. The company is Algorhythm Holdings. And, usually when you see a chart go straight up like that, you assume
A miracle drug, a buyout from a tech giant.
Exactly.
Yeah.
Or a massive defense contract, something huge. But here's the twist. And this is what makes it the weirdest story of the year so far.
Let's get that in.
If you looked at this company, say, 3 months ago, they weren't doing high-frequency trading. They weren't training neural networks. They were selling karaoke machines.
That's the unbelievable part. Until very, very recently, this was the singing machine company, the world leader in consumer karaoke hardware.
We're talking about the plastic box with the disco lights you buy for a 12-year-old slumber party. And suddenly, on February 13th, 2026, they're the hottest AI stock on the planet.
It's quite a pivot.
So I think the mission for this deep dive is pretty clear. We have to figure out if this is the greatest corporate turnaround in history or if investors have just completely lost their minds.
It's the multi-million-dollar question, right? Is this a gap-and-go opportunity, or is it pure vaporware, a trap?
Right.
But I think if we just focus on the stock price, we miss the bigger picture here. This is really a case study in agentic AI, market psychology, and frankly, the innovator's dilemma playing out in real time.
Well, let's start there with the pivot itself. Because a company doesn't just wake up one morning and decide to stop making microphones and start managing global logistics.
Yeah.
That feels desperate.
Oh, it was desperate. We have to be honest about their history. Under the old ticker, MICS, this was a 40-year-old consumer electronics business.
And that's a tough place to be.
It's brutal. You've got tariffs squeezing you. You have declining hardware sales. The margins are just razor thin. The analysis we read makes it clear their historical financials were bleeding out.
So they were staring at the abyss. It was either die a slow death selling karaoke machines or try something completely wild.
Exactly. A real burn the boats moment. So in late 2024, they rebranded to Algorhythm Holdings, and they acquired a subsidiary called SemiCab.
SemiCab. Okay, so this is the entity that actually matters now. The karaoke machines are just the legacy baggage.
That's right.
What is SemiCab actually selling? Because, everyone claims they have AI now. Is this just buzzword salad?
And that's where we have to get really specific. They aren't just selling automation, they're selling an agentic AI platform. And that distinction is crucial.
Okay, break that down for us. How is agentic AI different from, say, the software FedEx uses to route a truck?
So think of traditional automation as a flowchart, a rigid one. If X happens, then do Y. It needs a human to set the rules, to monitor for exceptions.
It's a tool.
It's a tool. Agentic AI implies agency. It means the software acts like an autonomous agent. It looks at a chaotic marketplace like freight shipping, and it makes complex decisions on its own.
Like what kind of decisions?
It negotiates rates. It matches empty trucks to available loads. It solves problems without a human holding its hand.
So it's not just a tool for a human broker to use. It is the broker.
That is the core claim. In the logistics world, brokerage is that middleman layer. You have a shipper with goods, a trucker with an empty trailer. Connecting them is traditionally incredibly inefficient.
Lots of phone calls.
Armies of people on phones, sending emails, haggling over fuel surcharges. SemiCab is claiming their code replaces that entire human layer.
Which brings us to the catalyst. This was a penny stock, trading under $1. Nobody cared. Then, on February 12th, they drop a white paper. Now, I've read a lot of white papers, and usually the market just hits delete. Why did this one set off a bomb?
It was one specific statistic, one line in the whole report. The paper claimed their AI can scale freight volume 400% without adding headcount.
400%.
In an industry where you measure efficiency gains in, fractions of a percent, a 4x scalability it's unheard of. It implies you can completely decouple your revenue growth from your labor costs.
And the market panicked.
Panic is absolutely the right word. And here's what's so fascinating. It wasn't just RIME exploding up. It was the giants crashing down.
Right. I saw that.
Look at C.H. Robinson, ticker CHRW. Look at Landstar. These are multi-billion-dollar titans, and they took a significant hit the moment this tiny ex-karaoke company opened its mouth.
That seems almost irrational. C.H. Robinson is a fortress. They have billions in revenue. Why are they scared of a company that was selling microphones last Christmas?
It is the classic innovator's dilemma. C.H. Robinson's entire business model is built on people. They have thousands of human brokers. That's their asset.
But it's also their biggest liability.
Exactly. If RIME is right, and that is a very big if, but if they're right that you can automate that job, then C.H. Robinson is in deep, deep trouble.
Because they can't just copy it.
How could they? To copy it, they'd have to fire their own workforce. They'd have to cannibalize their own revenue streams and restructure their entire corporate DNA. A tiny startup has nothing to lose. A giant has everything to lose.
So that fear that their whole model is suddenly obsolete, that's what the market priced in.
Investors are betting that RIME is the asteroid and the legacy carriers are the dinosaurs. Or at least they're betting that RIME can steal enough market share to be worth a whole lot more than a $20 million market cap.
Okay, but I have to play the skeptic here.
No.
We've talked about the story, and the story's great. It's David versus Goliath. But when I look at the actual numbers, I mean, they are ugly, like hide the children ugly.
They are objectively terrible. There is no sugarcoating it. If you look at the trailing 12 months, their revenue is about $23.5 million. But even that's misleading.
How so?
Because the legacy karaoke revenue is falling off a cliff, and the new AI revenue is, barely starting.
And the bottom line?
Deep crimson. Net income is negative $23.26 million.
So for every dollar they brought in, they basically lost $1.
Essentially, yes. Earnings per share is negative $5.62. And the most critical number, cash flow, is negative $14.15 million.
That's the burn rate.
That is the how long until the lights go out rate. They're burning cash just to keep the lights on and develop this AI.
So we have a company with a market cap, before this pop, of around $20 million that's losing money hand over fist. By any traditional metric, this is a sell. It's a disaster.
If you used a standard price-to-earnings ratio, a PE, it's uninvestable. The PE is listed as NA because you can't divide by negative earnings.
So why on earth are people buying? Why did it go up 232%?
Because of what we call the valuation paradox. You have to completely shift your mental model here. Investors aren't looking at this like a mature logistics company.
What are they looking at it as?
They're treating it like a venture capital stage AI startup that just happens to be inside a public shell.
Explain that distinction. That's important.
When a VC firm invests in an early-stage AI company, they don't care about today's profits. They expect losses. They're betting on the TAM, the total addressable market. They're betting that these ugly numbers are just the cost of building the machine.
So RIME is basically a high-risk tech startup that you can buy on Robinhood instead of needing a meeting on Sand Hill Road.
That's a perfect way to put it. It's a public shell acting as an incubator.
Okay, let's dig into the math of that bet then. The analysis details this David versus Goliath thesis, comparing RIME directly to C.H. Robinson. Walk me through the margin argument, because I think that's the key to the whole upside here.
It is the absolute hinge of the whole thesis. Look at C.H. Robinson. They typically operate with a gross margin of around 15%.
Meaning for every $100 to ship a crate, they keep about $15.
Right. And out of that $15, they have to pay the broker salaries, the office rent, the phone bills. It's a service business. It's very heavy on overhead.
And semicab, the AI.
Because it's agentic AI, the variable cost of doing one more transaction is near zero. The software doesn't need a salary, it doesn't need health insurance or a coffee break. So the theory is that their margins could look like software margins.
SaaS margins.
Exactly. We're talking 40, maybe 50%. Maybe even higher.
That is a completely different economic animal.
It's why SaaS companies trade at 10 times revenue and logistics companies trade at, half of revenue. The market is saying if RIME pulls this off, every dollar of revenue they earn is worth 10 times more than a dollar earned by C.H. Robinson.
The report also mentioned market share. They don't need to actually kill the giant to win, do they?
No, and that's the beautiful asymmetry of the bet. C.H. Robinson is massive. If RIME can capture just 0.1%, 1/10 of 1% of Robinson's volume, but do it with those 50% SaaS margin,
The valuation would explode.
the fair value of RIME stock would be 10 times higher than it is today.
So the bet isn't RIME takes over the world. It's just RIME proves the model works and takes a tiny, tiny slice.
Precisely. That potential is what drove the buying. But, and this is where we have to pivot to the mechanics of the trade, none of that fundamental math explains a 230% jump in 6 hours.
No. That screams technicals. That just screams squeeze.
It is a textbook perfect storm of market mechanics. First, you have to look at the float.
Right. Walk us through the float dynamics here. Why does that matter so much?
The float is just the number of shares that are actually available for the public to trade. And RIME has a tiny float, about 2.4 million shares.
And to put that in perspective, a company like Apple has billions of shares.
Billions. So imagine a sold-out stadium trying to exit through a single door. That's a low float stock. When demand spikes, when everyone reads that white paper at the same time and hits buy, there's no supply.
So the price doesn't just tick up.
It gaps up. It skips entire price levels because there are simply no sellers there. It's liquidity starvation.
And then you add the gasoline on the fire,
The short interest.
The people who were betting the company would go to zero.
Yes. And look, logically, they were right to do so 3 months ago. They were shorting a dying karaoke company. They looked at the declining mic sales, the tariffs, and they said, this thing is dead.
And then they woke up on February 12th.
And realized they were suddenly shorting an AI momentum play. The entire narrative flipped overnight. Now they're trapped. To close a short position, you have to buy the stock.
So as the price rips higher, the shorts panic buy to get out, which drives the price up even more.
Which forces more shorts to cover. It's a vicious feedback loop, a classic short squeeze.
The analysis mentions some psychological price levels. Where do you see this going?
Well, it looks like $3 is now the new floor, the new support. The psychological target is probably $5. But with this float, if this AI scare trade keeps hammering the competitors, you could see a speculative, irrational push toward $8 or even more.
$8.
Yeah.
From 80 cents. I mean, that is just staggering.
It is possible.
Yeah.
But we have to be very, very careful here. We cannot get carried away with the rocket emojis. We have to talk about the death spiral.
Right. Let's look down the cliff. Because that cash burn we mentioned, that negative 14 million, that doesn't just go away because the stock chart looks pretty for a day.
No. In fact, it makes the next few weeks the most critical period in this company's entire history. They must raise capital. They're running on fumes.
The report predicts a secondary offering. Explain what that means for the listener who might own the stock right now.
A secondary offering is when the company basically prints new shares out of thin air and sells them to the public to raise cash. And usually that's bad news for existing shareholders because it dilutes them. It makes their slice of the pie smaller.
The price almost always drops on that news.
Almost always.
Okay.
But here, the context is completely inverted. This is what the report calls the probable move.
How so?
Well, there are two scenarios. Scenario A is the bullish case. They use this massive price spike, let's say the stock's at $5, to sell new shares. They could raise $50 or $100 million with very minimal dilution because the price is so high.
And that's a war chest.
Suddenly, the bankruptcy risk is off the table. They have the money to hire engineers, to market the platform, to survive for 2 years. The high stock price actually saves the business.
It's reflexivity. The market believing they're real gives them the money to become real.
Yes. But then there is scenario B.
A bearish case.
The stock crashes back down before they can get the offering done, or the terms of the deal are predatory. If they can't raise that capital, that burn rate eats them alive. They go bankrupt.
So it really is a binary outcome. This is not a safe dividend-paying hold. It is a lottery ticket.
It's a call option on disruption. That is the best way to view it. It's a 10-bagger or it is a 0. There's not much in between.
The report mentions a specific date to watch. Q4 earnings, expected in late March. Why is that date so important?
Because that's the moment of truth. Right now, all we have is a white paper and a promise. In late March, we get the actual numbers. We need to see if that 400% efficiency is actually showing up in the gross margins.
We need to see if the AI is actually moving boxes or if it's just moving stock prices.
That's it, exactly. If the earnings call sounds like more marketing fluff, this stock goes right back to 80 cents. If they show real traction, then $5 might start to look cheap.
It's wild. You know, taking a step back from RIME specifically, what really sticks with me is the sector itself. Logistics, trucking, it's boring, it's invisible.
It's the absolute backbone of the economy.
Right. And we always talk about AI coming for the creative, jobs writing, coding, art. But this suggests that the biggest disruptions might be in the boring stuff, the invisible middle layers.
That's where all the friction is. And friction is just another word for money. Logistics is a low-margin, high-friction business. It's inefficient by nature because it relies on humans talking to other humans.
And if you can replace that friction with code,
you unlock billions in value.
It just makes you wonder what else is out there. If a karaoke company can pivot to threaten logistics giants with a single algorithm, who's next?
That is the provocative thought I'm left with. What other boring legacy industries are just one AI breakthrough away from being turned completely upside down?
Is it insurance?
Insurance is a huge one. What do actuaries do? They predict risk. AI does that better.
Waste management, construction.
Commercial real estate management. I mean, think about it. Anything where you have a middleman taking a fee just for coordinating between two other parties, RIME is a warning shot to all of them.
No industry is safe from efficiency.
And if RIME proves that you can pivot a dying legacy hardware business into a cutting-edge AI disruptor, we might see a lot more of these strange pivots in the next year or two.
So if you're listening to this, keep your eyes on the ticker, but keep your eyes on the horizon too. Because the next big disruption might come from a company that right now is making toaster ovens or lawnmowers.
Or karaoke machines.
Exactly. We'll be watching that March earnings date very closely.
Don't forget to like, share, and subscribe for more.